This video is sponsored by Skillshare. Go to skl.sh/theplainbagel2 to get a free 2-month premium trial. As many viewers are aware, it's become increasingly harder for investors to secure a reasonable yield on fixed income investments in the current environment. Yield is, of course, the income return of a security, the money it pays you divided by its market price. And with low central bank interest rates and high bond prices, many corporate bonds that are investment grade offer a yield that's barely above inflation. This has forced income investors elsewhere, and some have found themselves buying up the preferred share, an instrument that pays a regular dividend and currently yields between 5 and 7% in Canada. Pretty attractive, right? But remember, higher return comes with higher risk. And unlike the common stock, preferred shares can be customized by the issuing company with a load of varying features, some of which fundamentally change the security for the investor. So before you chase the high-yielding preferred share, let's go over the pros, cons, and the features of the security on today's Plain Bagel. Preferred shares are a hybrid security that's known as the safer, less exciting cousin of the common share. It's an income instrument that pays a regular dividend, and as the name suggests, it has certain privileges over the mere common shareholder. For one, its dividends, also called preferred dividends, tend to be higher, are fixed, and are paid before the company can pay any distributions to the other common shareholders. It is also senior to common shares, meaning that in the case of bankruptcy, they recover their losses before common shareholders, though this is only after creditors have had their pickings. At first glance, preferred shares probably sound a lot more like a bond than a form of equity. And indeed, investors treat the security as a substitute instrument because, as you'll see, the similarity between the two runs a lot deeper than you might see at first glance. For one, preferred shares don't offer the investor any voting rights over the company, meaning that while investors owning the common stocks of a company can actually control the firm with a majority stake, preferred shareholders don't have any say on how a company is run, much like bondholders. Preferred shares even come with a par value, essentially how much the company originally borrowed from the investor. And there are some instances where this amount is paid back. The market price of a preferred share is also typically range-bound to its par value. Again, much like bonds. In Canada, preferred shares often trade with a par value of $25 a share. And if you look at any given preferred, you'll see them trading somewhat close to this value. So while a preferred share's price and dividend don't have the same growth potential as they do with a common share, which can theoretically grow infinitely, they provide more stability for the investor. So you can see why many people treat the preferred share as a fixed income instrument rather than an equity. But if the preferred share is so similar to a bond, why is a security yielding double or even triple what a bond offers? Well, for all the similarities between the preferred share and the bond, there's one aspect that it's lacking, which is safety nets. For one, preferred shares don't have covenants, a set of rules that bonds have to protect the bondholder. These rules are imposed on the borrowing company to ensure that management doesn't do anything overly risky that might threaten its credibility. For example, a bond may limit how much a company can pay out in the form of dividends to shareholders, cap the amount of leverage it can have, and even prevent certain mergers and acquisitions. These are all things that decrease the risk of a company missing an interest payment. And if a company happens to break a bond covenant, the lender is typically allowed to impose a penalty payment or even demand a full repayment of the loan, helping the bondholder get out before things get even worse. So you can see how covenants make bonds a pretty safe investment. But as we mentioned, preferreds don't have the same set of rules. After all, the security is technically a form of equity, not debt. So it doesn't impose the same restrictions. Great for a company looking for financial flexibility, less so for the preferred shareholder. There's also one other teensy little detail that really separates preferred shares from bonds. The fact that the issuing company doesn't technically have to pay you your dividend. Yes, there is a promised dividend that comes with a preferred, but if a company finds itself strapped for cash, it can put off paying the amount. With bonds, a missed interest payment means the company has defaulted and needs to either liquidate or file for bankruptcy protection. But again, since a preferred share technically isn't a form of debt, a missed payment doesn't constitute a default. Now, before you go raising your pitchforks and demanding change, it's worth noting that companies won't go flippantly canceling their dividend payments to preferred shares. Doing so is typically more damaging than canceling a common share dividend, as it signals that the company is really struggling. And the move would hurt the firm's stock price and their ability to finance moving forward, since it erodes their credibility. Nonetheless, there is still a risk here. especially for income investors who rely on the cash flows from their portfolio. So while preferred shares look and act like a bond for the most part, they don't offer the same safety nets and guarantees. This is why preferred shares tend to fluctuate in price more than bonds. Yes, they are typically less volatile than the common stock, but they still face some equity risk and can drop significantly in price with the markets, while a bond experiencing a price decline can simply be held until maturity if the investor wants to get their money back. So those are the main pros and cons of the security. It offers a high yield, but comes with more risk than your standard fixed income security. Preferred shares are also usually less liquid than bonds and common stocks, meaning that they can be hard to sell, especially in a downturn. Whereas popular stocks can have a sell order filled in milliseconds, preferred shares can take days or even weeks to find a buyer, and that's when times are good. But in addition to these basic details, there are a lot of individual features of a preferred share that can further augment its risk-return trade-off, making the security riskier or safer to offer correspondingly higher or lower yield. For one, preferred shares can either be cumulative or non-cumulative. Cumulative preferred shares will pay a preferred shareholder back any dividend payments a company has missed once it is able to make the payouts, whereas missed dividends with a non-cumulative security are gone for good. Many preferred shares are also callable at a predetermined price close to their par value, meaning the issuing company can buy back the security after a certain date if it chooses to do so. This is something that caps the upside of the preferred share's price return. A company may be able to buy back its preferred share that has a market price of $30 a piece at $25 from the investor. But again, these securities will typically pay out more as compensation. On the flip side, some prefs are retractable, basically meaning that shareholders instead have the right to exchange the security for a certain predetermined value at a specified date, something that would lower the security's yield. Preferred shares can also offer a varying payout. Floating and rate reset preferred shares change their dividends over time depending on some benchmark rate, with rate resets only adjusting their rate on the specified rate reset date. Rate reset preferred shares are actually the most common form of preferred share in Canada, and unlike bonds, they tend to move in the same direction as interest rates. For example, here are two graphs showing the price of ZPR, a Canadian preferred share ETF, and ZCM, a Canadian corporate bond ETF. In 2015, the Bank of Canada cut interest rates twice, and well, you can see the impact on the two ETFs. Finally, some variable and rate reset preferred shares offer a rate floor, essentially a minimum level that the dividend cannot fall below. This can ensure the yield doesn't fall if interest rates go down too far, but again, usually provides a smaller income than an equivalent preferred share without the floor. So that is the preferred share in a nutshell. As you can see, it's a pretty unique instrument with a lot of moving parts. And despite its pitfalls, it can be a very useful investment. For corporations, these securities allow management to raise capital without diluting ownership of shareholders or risking a default. And for investors, they can offer an attractive source of income. Not to mention that in Canada and the US, they're actually taxed more favorably than the interest payments on a bond, depending on certain factors. But be aware that the risk profile of a preferred share falls somewhere between that of a common stock and a bond. And as with all investments, its suitability for your portfolio depends on your unique circumstances. So before you go chasing the high yield offered by the preferreds, make sure that the features suit your, well, preferences. Thanks for watching. If you like this video, make sure to hit the like button. And if you like what we're doing here, make sure to subscribe. Hit the bell icon if you want notifications about future videos. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today. This video is sponsored by Skillshare. Skillshare is an online learning community that offers thousands of classes that you can use to try something new or further your mastery in a skill you already have. Their courses are video-based, conveniently segmented into short lessons, and cover a variety of topics. For example, if you're looking for a great supplement to your plain bagel diet, Investing 101 Understanding Stocks dives deeper into specific ratios, stock classes, and types of analysis. Or if you're looking for a creative outlet and maybe want to make videos like I do, you can check out Video Editing with Adobe Premiere Pro for Beginners. It's a course I've taken myself that's really improved my workflow on the channel and just the overall quality of my videos. Skillshare offers these courses and many more on everything from painting and creative writing to coding and analytics. And if you're interested in trying it out, you can access it for free for 2 months by visiting skl.sh/theplainbagel2. The link will give you a trial of Skillshare's premium membership that normally costs $10 a month, and it will support the channel, showing Skillshare that I sent you their way. So whether you're looking to further develop a professional skill or just interested in trying something new, I encourage you to check out Skillshare.